Hi, and welcome back to the Business Career College video series. This video will be part 8 of the series around multi-year cash flow using Excel. This is really designed for students going through a Capstone course. It's a little bit complicated here, and it's very purpose specific. So if you're watching this out of general interest, you might find yourself bogged down fairly quickly. For those watching for their Capstone course, take your time, work through it. You're going to have to do a couple things a few different ways. So I've jumped ahead a little bit here, and what we have, I've got a table now built out for Jeff and Tina, and we've got an RSP balance. So this is really where I want to start from, is assuming we built up a pool of retirement savings. So we can see here that Jeff has built out this RSP balance. He's going to get to retirement, which we currently have set to his age 65. So after 65, he's going to be retiring and will have no income then. He will, on the other hand, still have this RSP balance here. So what we really want to do is figure out how much he's going to take out of that RSP in any given year. So we don't have any space here for an RSP withdrawal. So the first thing we're going to do is we're going to build a row here for an RSP or RRIF withdrawal. It doesn't really matter. It does matter in terms of withholding taxes, of course, and the spousal RSP, but really for the purpose of these long-term projections, it's not that big a deal. Oh, and income splitting too. It's not that big a deal whether we're using the RSP or the RRIF. So let's just assume that we're just figuring out whether he's going to have enough money to get him where he's got to be. So the amount that he's going to take out, he's not going to take anything out of this RRSP or RRIF if he's got income. So the first thing we're going to start off with here is a little if statement, and fairly straightforward here. We can just say, hey Jeff, if you've got income, so if that's anything more than 0, well then we don't need to worry about this. So we just built an if statement here, and we can see our logical test. So if before income for the current year is greater than 0, then we're not concerned about it, but the way we're going to take care of that is just to 0. There's going to be no RSP withdrawal, but otherwise we're actually going to jump to the formula bar here. We're going to solve for a payment. So we're going to base our payment then on the amount that he could take out if he were retired. So we're going to go to our data sheet, and we're going to use the appropriate rate of return here. So we do have to come up with rate of return. For now, we're just going to build a blank spot here. So we know we're going to refer to data B11. We know we're going to have to use the F4 function there. And the number of periods here. So this is going to depend on Jeff's projected mortality. So we're going to do something similar. Actually, we're going to build projected mortality here. And again, we're going to F4 that. And we're going to take that projected mortality minus his current age. So then we're going to pop back to that sheet that we're working on here. And we're going to subtract out his current age from that. And we don't need to F4 that. And that's just going to tell us then however many years minus current age, and that'll tell us what the available payment would be. The present value will simply be the RSP balance, and that's going to be negative. We want to do that as a negative. We'll do the RSP or RRIF withdrawal, then it'll show up as a positive. So we'll take the RSP balance here. And future value is going to be 0. Now we could do begin or end here, but it's not really that significant, again, given that it's really just these long-term projections. So now we can run that out. Now we do have to remember to go back. We're going to have to adjust our B11. That's going to be our retirement rate of return. And we're going to have to also adjust our mortality age. So let's go to our data sheet. And we're going to do rate of return in retirement. and we're going to do mortality. So let's do mortality at age, whatever, we'll do it for Jeff at age 95. It does matter, but we're just making a guess here. We could pull that off the FPSC assumptions guidelines, and we'll be okay. We're going to change that to a number. We're going to change it to 95 as opposed to 0.95. And that rate of return in retirement, well, there's a bunch of different stuff that we could do here. So we could make a determination around the extent to which Jeff would have an asset allocation, or how his asset allocation would look. So what we might do around that asset allocation, maybe we're going to just make an assumption here. If you wanted to get fancy, you could actually play around with this a little bit, where you could do a weighting based on how much fixed income and how much equity there is. For our purposes, because I don't want to get too focused on this for this video, we're just going to do a quick 4.2% rate of return. Now, what I would do, and what I think is actually fairly important here, is that I actually would build this to accommodate inflation. So what I really want to do here is I'll do the rate of return in retirement here at 4.2%. And then I'm going to do this as the inflation adjusted, or the real rate of return. And the reason for this is because we have to have our the amount of payment, is going to have to increase every single year. So really, you've got to take that into account when you solve for whatever payment you're generating here. So we can do real rate of return. We can just use our real rate of return formula, which is going to be real rate of return minus inflation, all divided by 1 plus inflation, and that'll give us the rate of return that we should actually be using, which should be this 2.16. And my RSPs should have adjusted to that. It did. So now we're looking at B12 for our rate, and we're looking at B13 for our mortality. And let's just make sure those match up. So I've got B12 for my rate and B13 for my mortality. Perfect. And we can pop back here. And now we should be able to copy this formula across. And we should see at some point that Jeff is going to start taking withdrawals from the RRSP. Now we have a little bit of a gap here, and this is where this is not perfect, and I'll fix this in a second, where we can see that at age 66 he's going to be able to start taking $71,990 a year out of his RRSP. Now what's not reflected here, we can see the RRSP is only accumulating, it's not reducing. So what we should do is we say, all right, for this RRSP, when we start to do this, we're going to take any withdrawals from the previous year out, and now we just copy that formula all the way across. Now we've got him dying at 95. We did our mortality at 95, so I don't really care about these inconsequential values. The reason for that is because that's beyond when he's dead. So we can see now that we are pulling a little bit of money out of the RRSP every year, and it actually, because we did use that real rate of return, that's how we're accommodating inflation, so that his amount that he's taking out of the RRSP or RRIF is growing every year, and that'll help to deal with the consequences of inflation. So I hope that that does make some sense. Now we're not quite done yet. That's the most important part and generally the most challenging part. We're now going to go back to the multi-year cash flow, and we're going to represent this here. So we want to say now, and I have an old formula in here, don't worry about that right now. We know then the amount that he's going to take out from the RRSP, we have that calculated over here. We can just run that equal to that number. And we can copy that all the way across. Now, if we did our And by the way, if we did go and change things in our data, if we changed the retirement age, or if we changed the mortality, that would have corresponding impacts on everything that we just did over here. We'll see now that the income should be a little bit less for that first year of retirement because we've got more years we have to accommodate. And we'll see here that this will run us out to age 98 now, not to age 95. So on the multi-year cash flow then, we know that there's going to be money coming into his hands out of the RSP here, but really it's going to be tax on that. So again, I have an old formula here, but we're just going to take the amount that we would be taking out of the RRSP, whatever that should be, and we're going to knock that down by whatever the appropriate marginal tax rate is. So we just have to tax that. That's going to pull that off our data sheet. And we've got tax on RRIF withdrawals at 30%. And we're going to for that. Good to go. And now we should have whatever the amount down below here is, so that when Jeff starts taking money out of his RSP, the 67,131 is the gross amount, and the 46,992 is the net amount, and that's really what would impact on the surplus or deficit that we're building towards. And I'm just going to take a second here, and I'm going to rename this as Jeff's RSP withdrawal and Jeff's net RSP income. Okay, something to that effect. And take that comment out now. That's fine, just like that. That's good. And we've got now everything done accordingly with a proper representation of the amount of income that Jeff would be generating every single year from that RRSP. So I hope that that helps. I know it's a little bit complicated, but if you just use that solve for payment at the appropriate time and have all your other moving parts done accordingly, you'll be in good shape. There's one last thing that we want to do around this, and in the next video I'm going to show you how to make sure that the amount that Jeff is taking out of his RRSP corresponds to whatever RRIF minimum there happens to be. So thanks very much, and please do enjoy your continued studies.